finally you come in terms of how do you rebalance, right? There is something called a constant plan, right? It's called a constant rupee plan, right? One second is called a constant ratio rupee plan, right? One third is called a variable ratio plan, right? And the fourth is not a plan, but it is something called systematic investment. So I will just deal with the first three, right? It's a constant plan. Okay? Now, for example, you have 1 lakh rupees invested, right? 80,000 you have invested in equity and 20,000 in debt, right? Now, in this case, what you have done is you have in a constant rupee plan, you have fixed the amount of 80,000 as equity and 20,000 as debt. Now, suppose what happens is that the value of your portfolio goes down by 10,000, your equity portfolio. What you will do is, right, you will immediately go get out of debt 10,000 and put it into equity, right? Because that is the value of your portfolio in the sense that equity should remain as 80,000, right? That is constant sum. Okay. In a constant ratio plan, you fix a percentage of equity versus debt. For example, you want 50% equity, 50% debt. Now, assuming again, let's take the same example, 1 lakh. So 50,000 equity, 50,000 debt. Now, suppose let's say the value of your portfolio, equity portfolio comes down by 20,000. So what is the value of your portfolio now? 80,000? No, it should 20,000. It should come down to 30. Right? The equity goes down to 30 and the debt remains as 50. So now you have 30 equity and 50 debt. Total value is 80. Right? Now in this case, it should be 50%, 50%. So 10,000 you remove from fixed income and you put it into equity because the percentage of equity in debt should remain as same. Right? Variable ratio basically means in terms of, you decide a arbitrary ratio, whatever you want to fix up, right? And if the markets are rising, okay? So if, for example, this is the value of your portfolio, right? For example, if it says, goes up to 1,20,000, right? Now in that 1,20,000, you decide that, okay, 1,20,000, now in that case, I should sell shares, okay? Because here you fix that, a variable ratio is depending, the ratio between equity and debt fluctuates. Okay. In a rising market, the proportion of your equity falls, whereas in a falling market, the proportion of your equity rises. The logic of this particular reason is that in a rising market, liquidate your investment, so whatever gain you have, right, get out at an expensive rate and make whatever return that you have. In a falling market, they say increase your proportion to equity because then in that case you get shares cheaper. Right? So here, here in the other months we were also we had the same strategy, but it was not so in terms of deciding that depending on whatever the markets, you're not really going rigidly in terms of buying shares cheaply or expensive. But in this case, it's a very clear strategy that if the markets are going up, right, move out of the markets because the value of your portfolio is gone up. So you start at a particular level, say that okay, 1,20,000, okay, move out, come back to 1 lakh. So 20,000 you liquidate, put it into debt. Suppose it comes down to 80,000, right? So 80,000, okay, fine. Liquidate 20,000, put it into debt. So the ratio that you have is going to keep changing. We are not fixing an arbitrary ratio between debt and equity. The idea is that if markets are going up, sell your stocks. If the markets are going down, buy stocks. So you get stocks at a cheaper price. And the third, of course, is a systematic plan, right? Now, a systematic plan is something like a mutual fund systematic investment plan. You allocate a fixed sum of money at regular intervals of time to buy shares. Now, see, there are again advantages and disadvantages. Right now, if you have a situation where the stock price continuously rises, in that case, a systematic investment plan does not work, right? Because suppose, let's say, at a point of time, the share price is, let's say, 10 rupees. Okay. Now, you've invested 1,000 bucks, right? How many units are you getting? 100, right? Now, let's say it goes up to 20 units, right? So, in that case, 50. Then, again 100, suppose 25, then 40. So, because the share price is rising, right, you will obviously get lesser and lesser amount of stocks, right? So suppose if you decided to invest 12,000, right, the total number of shares that you will get at the end of the year will be lesser. But if you had decided that right at the beginning I am going to invest 12,000 rupees at the rate of 10, right? So 12,000 divided rupees, you get far number more of shares in a, at the point of time of immediately buying it, rather than doing it at intervals of time. On the other hand, if you have a situation where the share price fluctuates, right, sometimes rising, sometimes falling, right, in that case, more often than not, you are better off in a systematic investment plan rather than in a plan where you invest at a particular moment of time. Secondly, systematic investment plan is also better because, see, sometimes it's very difficult to figure out what is the right time to buy. Right? Can you actually, pick up a moment that, okay, now this is the right time for me to enter? It is very difficult for most of us to actually ascertain what is the correct moment of time that we have to enter into the market. Right? So a systematic investment plan is particular sum of money at a particular date. Right? So there will be some averaging out. Right? It will be a regular investment plan. One doesn't have to worry. Right? You don't have to worry about particular time to get in. Right? And over a period of time, there will be some averaging out. So the net effect is that you will gain, right? Because sometimes you do expect the stock to go down, sometimes you do expect the stock to go down. Right? So these are in terms of, broadly in terms of how to rebalance your portfolio.